So you want to know how the stock market works? I'm going to tell you how it works in about 60 seconds. That is a bold, that is a bold thing to say, a bold thing to attempt to do, and live, nonetheless. But I'm going to try. So basically, I want this to be there's a lot to the stock market, but the thing is, a lot of people get intimidated by the stock market and how it works, not what it is. What it is, the ability to own potential, partial ownership in a company. It's a way for the companies to raise capital, but that's not what I want to talk about. I want to talk about how it works in a way that anybody can understand. Soccer moms, anybody. All right? Stock market basically, listen up. Stock market basically is like eBay. That's the way it is. Think of it as eBay. All right? And I'm going to explain what I mean by that. My name is Carlyle. This is Carlyle Speaks Wall Street. And I have right now the top rated database video right now, over 500,000 views. One of the top rated options videos. I have over, I think it's 6,000 students right now for my online courses. And today we're talking about the stock market. So the stock market basically is like eBay. It is an auction-based market where the highest bidder wins, and it's all about demand, right? So think about eBay. So eBay, you have people that are selling products. So I want to sell my lucky socks, right? I got my lucky socks, and I want to sell them, right? Now, depending on the demand, you'll have one person that wants the socks and they will bid, right? And then someone else wants them even more. So one person bids $10. The next guy says, I want it more than that. I'll pay $15 for the socks. $15 for the socks, I'll bid 15. Somebody's like, oh, I want those socks, man. $20, I'll bid 20. $20, $20, $25, $30, right? People are bidding and the price goes up and up and up and up and up until the highest bidder, right? Highest bidder comes in. Whoever wants it the most, they get the product. They win. Sold to the guy for $100. That's how it works. Demand is low, you don't have a lot of people bidding, so the price doesn't go high, so it gets sold for a lower price, right? People determine, like, who wants these lucky socks, right? So when I put my socks for sale, I only get like $5 bids or whatever. That's how it works. Also, you have things like limit prices. You can think of that as, with eBay, you can put sort of your max bid. So max bid is you're willing to pay up to that or better, right? So you put your bid in $5, your max is 50. You bid five, somebody bid six, somebody bid seven, somebody else bid eight, and it keeps going up and up and up until it hits your max. After it hits your max, it doesn't bid any higher than that because that's your limit. That's how it is in a stock market. Stock market, you can, when you place an order to buy something, you can determine the price you want to pay, whether it's market price. So you're just going to pay, you're gonna pay whatever the market conditions are bearing right now, or you can put a limit and say, you know what, I don't want to pay more than this, right? And then you can sort of limit it. But that's basically the way to think about the stock market. It's an auction-based market where people are bidding on the product being shares of ownership in a company. They say shares or stocks, right? That's what they're referring to. Back in the day, you would have stock certificates. Now it's all electronic. It's all digital. No one gets stock certificates anymore, right? It's all electronic. But the bottom line is people, as an investment objective or strategy, they're like, okay, I feel like Apple's a successful company. I think Apple is really, really doing some amazing things and they have an amazing future. So I would like to invest in Apple. So I'm going to buy shares of that company. And then based on how much the demand is, that's going to determine how much I'm going to pay because other people wanting Apple as well, they're going to be bidding. I'm going to be bidding. We're all bidding. And again, just like eBay, high demand, price goes up, low demand, price goes down, right? Ultimately, you get your execution. You now have a certificate of ownership in the company, small percentage for most of us, right? And if the company does well, the value of those shares go up, right? Value of those shares go up. So therefore, since it's transferable, you can sell it, right? Just like eBay. Let's say I buy the latest Xbox, whatever it is, and I pay $300 for it. Let's say for some reason in the future the demand goes higher. For whatever reason, the demand goes higher on these. So I paid $300 for the Xbox. Now there's a shortage of Xboxes, and people are like, they really want them. I can take the Xbox that I bought on eBay and sell it for $350, $400. You know, if the demand is crazy enough. Let's say for some reason I end up with one of 10 Xboxes left in the world. How would that happen? I could maybe sell it for $1,000, $2,000, 20, 50,000. I mean, you know, the sky's the limit. But that's basically how that's basically how the stock market works. So if you understand eBay, then you understand the fundamentals of how the stock market works. Obviously, there's much more to it than that, but the fundamental principle is based on that structure of bidding also on demand, and that's it. I think the main thing to also think about is with eBay, it's one, usually you think of it as one person selling one product. With the stock market, it's not just one person, not just one share. So, you know, people can bid, sold to one guy, but then there's more of that same item. Someone else can also bid in a separate auction. You know, let's say I'm selling 100 pairs of my lucky socks, right? So I just sold one pair, and I have another auction going, and it sells for that pair, for that price, and then another auction going. Highest bidder was that. Demand goes up. I keep my sell price keeps getting higher and higher and higher. Demand goes down, my sell price keeps going lower and lower and lower, right? It's based on demand, you know, what kind of money I'm going to get for whatever it is that I'm selling. So that is essentially the core of how the stock market works. So if you can understand eBay, you can understand how the stock market works. On a final note, people use the stock market as a general term, you know, in terms of just trading in general, but there's lots of other types of securities or asset classes that we call them. The stocks are just one. Stocks, you're talking about stocks or equities. But you have things like bonds. Back in the day, there was a generic term. People always said, you know, stocks and bonds. People are not in industry and not necessarily knowing what that meant. But you have different types of instruments. You have stocks, you have bonds, you have options, you have futures, you have FX, you know, and there's other types of instruments as well. So just bear that in mind, that the stock market or stocks, that's just one piece of a massive pie. In particular, I'll even give you a interesting detail. And I did a video about this, the FX market. The FX market, the volume in the FX market massively crushes the volume of the equities market. So as big as the equities market may seem to be to you, it is nothing in compared to the FX market. And I urge you to take a look at my FX video where I cover that. Anyway, Carlos Speaks Wall Street, and that is how the stock market works. If you appreciate the video and you finally understand it, thanks to the way I explained it, then go ahead and click on the like button, share the video, comment below, and thank you for watching.